You're losing trades like this one because you don't have the proper stop loss and take profit targets, because if you've had the setup like this, you would have won the trade. But it's not that simple. What you need to know is that the setup positioning of the stop loss and take profit targets have a logic. The levels where the targets are placed have to make sense. And that is what we're going to cover in this video, so you can later expect this type of setups. The main problem stands in not properly understanding how market structure works. On the most basic way of explaining, the markets have two types of trends. An uptrend, where the market usually forms higher highs and higher lows repeatedly. Each past high is a weak high on uptrends because we expect the highs to break, and each low on uptrends are protected strong lows. So logically, when you're looking at this price action, where do you think are the most optimal buying opportunities? Now this question also depends on what type of trade are you looking for. You can look for a swing trade, which in this case the optimal buying level is at the lowest swing low, and here you would look to sell at the highest swing high. And if you're an intraday trader or scalper, you might look for buying setups on each higher low, and selling as an exit on each internal higher high. So scalpers look to trade multiple times inside an external price action. And on downtrends, it's the opposite way around. The downtrend price action is simply described as a market movement that constantly forms lower highs, followed by lower lows. Now if we know this simple theory, we should now know that on downtrends, each lower high is a protected high, since if the market follows a downtrend, the high is not meant to break, while the lows are the levels that should break, being named as weak lows. So the logical setup positioning during downtrends is to look to sell short the external high from a resistance or supply, with the take profit below an external low, this in the case for a swing trader. And for a scalper or intraday trader, a logical entry would be selling short at an internal lower high from an internal resistance or supply, with stop loss above the past internal high and take profit below the previous internal low. And once you get good at this, you can spot chain setups that follow the same type of price action, because usually after a break of structure, the market pulls back up, and if you trade based on the trend, then you would look to take down the market into a lower low for basically this price movement to repeat, since that is how a downtrend looks like. So let's see how this would look like on a live market. Here we see an uptrend, basically a constant repetition of a higher high with a higher low. We can notice how the lows do not break. For example, here we have protected lows. Then after the market pushed higher, then pulled back and continued the uptrend, validating another protected low, being a higher low. Then the same thing above, and here once again. Now here actually we can see that it broke this low with a wick. Now we don't care about wicks because they show liquidations and not an actual trend movement. We want a candle closure to validate the reversal or a continuation, but the low is still considered, but just not a valid breakpoint, because even the same candle that caused the downside wick instantly reversed back up, holding this uptrend with very bullish candles. But now it's when the situation gets more interesting, because the market pushes down pretty aggressively, and this downside move now actually closes with a full candle below the low. A candle closure below the protected low during an uptrend is the trend shift into a downtrend. On downtrends, we sell short the highs from a resistance level or a supply. The entry should be at around the level where the price hits this one, with the stop loss above the highs. This is important because it has a logic. Since the trend has shifted and reversed from an uptrend, and on uptrends the protected levels are the lows, well now the trend is bearish because the trend has reversed into a downtrend by breaking down the protected low. And on downtrends, now the protected levels that should not break are the highs. Basically, each swing high is a protected high that should not break as long as the downtrend is sustained. So in other words, we would expect a lower high, and on downtrends after lower highs, lower lows are expected. And that is where we would exit out of this position, hopefully, with a win. Now we just have patience. So far, the market is pulling back into the resistance or supply level, and the entry gets filled with nearly an instant large bearish rejection, from where the market held bearish momentum, until it finally broke below the lows, which means that the trade is closed with a win. Notice how after the trend shift into a downtrend, the market started respecting the downtrend fundamentals of a lower high, then a lower low that just happened recently, which closed the position. So we basically have formed once again a similar price action that validates after breaking the lows, so having a new protected high, which is a lower high. So if we know that the market should not break this high, we can use this in our advantage by selling short once again from this level, which is a resistance or supply. The positioning of the setup has the same logic as the previous one. Stop loss above the protected high, and take profit below the low. The position got opened, but soon after it rejected back down with pretty large bearish candles. Now this should hold bearish pressure for a while. And it did, winning the trade since a massive bearish candle pushed downwards into the lows. And if you notice, once again we have the same formation of a swing lower high, with a swing lower low. So pretty much this type can be done again, as long as the protected high does not break. So we zone out the resistance or supply, then we sell short with the stop loss above the protected high, and take profit below the low. And let's see, so far it's slowly moving up. And what a move, a very bearish move. This time we missed the entry, which will happen many times, but you don't need many wins because of the pretty high-risk reward setups. But you can see that the price action has still respected, which means that the market still formed a lower high below the past protected high, which forms a new protected high, from where the market formed a lower low. So basically the same price action. Now on another backtest. This market follows a high time frame downtrend, an external price action that forms lower highs, which are represented as protected highs, the first one being here, the next one here. Now if you pay attention here, the market actually breaks this protected high, but with a wick that instantly comes back down. I wouldn't consider this an actual break, but rather a liquidation. For an actual trend shift to happen, we should have seen a candle closure above the protected high, which did not happen in this case, so we can consider this as the next protected high. So keep in mind, we have lower highs that are represented with the protected highs, and being a downtrend, we also have lower lows. And each time the past low breaks down, the market forms the so-called break of structure. From where, as the theory says, shortly after a break of structure, a pullback is usually met. Pullback to fill a resistance or a supply, from where the market usually fills and rejects back down, breaking once again below the past lows, which in itself forms a new lower low. So again, we mark the break of structure. Because after a break of structure, a pullback is met, pullback that pushes up just to reject back down towards lower lows, which in itself, the formation of the lower low, validates another break of structure. But now here, it's when things get interesting, because what we've talked about so far is the external or swing price action, but there is also the internal price action that can be traded. For example, look here, when the price formed lower highs and lower lows on the internal structure, but a couple candles later, the price pushes to the upside with pretty bullish candles. This upside push breaks above the past internal high. So keep in mind that before this point, the internal trend was bearish, formed with internal lower highs and internal lower lows. But after this point, the internal market has reversed from an internal downtrend to an internal uptrend, which leads to a significant move to the upside. And the theory of the external or swing price action can also be applied on the internal one, and this will help us in getting great setups somewhat like this, for example. But there is a catch. To find this setup, we need to zoom into a lower time frame. We will do that on the next opportunity that we can spot, which should be around here, being the most recent price action. So we basically do once again what we've did before on the internal price action. If we take a look at how the internal price has moved, basically by forming lower highs and lower lows. So a simple downtrend, but then the market pushed up aggressively to the upside, this push breaking above the last internal lower high. So before this was an internal protected high, the previous protected highs were this one, and this one. But now that the market broke a protected high, the trend shifts into an uptrend. And usually if this would have been on a swing external price action, this would have been named as a simple trend shift or a market structure shift. But because this is inside the external price, meaning on the internal levels, we name this as an internal shift, or as an internal market structure shift. Now we don't just trade blindly from here, because the way to get a higher quality setup by trading the internal price action is to zoom into a lower time frame. And what we care about the most is around this level, being the most recent price action that we can see lately, being right after the internal trend shift. We can zoom into any time frame. However, from the hourly, I've tested that it works better if we zoom into the 15 minutes or the 5-minute time frame. It's up to your choice because you will find a similar price structure anyway. Now here we see that after the market has pushed up to break the 1-hour internal high, after each significant break, a pullback is expected. Now, the important factor here is that the pullback has ended and the trend has continued higher on the internal price action, basically having formed a break of structure here. Now, the setup should be inside this price structure, between the internal high and the internal low. And logically, we would want to buy at the lowest price, which in this case should be this level. So now we just plan the setup, especially that the price is looking like it's about to hit this zone. So a buy position, with the stop loss placed logically below the past protected low on this time frame, and the take profit placed logically based on market structure, would be placed above the weak highs on this internal price action. We basically want to see higher highs to form the break of structure, then pullbacks, but without breaking the protected lows. So the exact next two candles pushed above the high, now we get the pullback fills the demand or support, and we get a bounce to the upside, a great positive reaction, moving towards our take profit, which eventually hits a couple candles later. So that's basically how you can think logically the entry, the stop loss, and the take profit levels. It all has a logic to it, and they're not placed randomly. Because if we see a clear uptrend, it's normal to trade with the trend. In that case, we would expect higher highs and higher lows, and we just take advantage of it. Now, one last back test, this time having a market following an uptrend, with a higher high which is then followed with a higher low, then continuation into a higher high. On uptrends, the protected levels are the swing lows, this being the first one, from where the market pushed aggressively to the upside forming a local high, then pulled back down and continued higher. The break of the past high validates the new protected low, and on uptrends, right after the break of structure, it's often met to see a pullback to the downside, pullback that usually rejects back to the upside from a support or demand. And if you want to be more exact about the entry, you can take the demand zone from the last bearish candle before the impulse to the upside. This makes the zone smaller, which might increase the risk reward since we might buy at a better price. The stop loss placed logically below the past protected low, and the take profit above the weak high, but in such a way to have at least a 1 to 2 risk reward, which shouldn't be hard to achieve. So because the position is basically already opened, we just have patience. It nearly hit the stop loss. That's why it's crucial to understand that the setup targets, but especially the stop loss, has to have a logic for the placement and shouldn't be just placed randomly. Now, if we zoom in to check the price action, the market basically just pulled back down, forming a higher low, then it pushed above the past internal high. The break above the high validates the protected low. And on the most recent move, we've got a pullback that happened soon after the break of structure. Pullback that also ended above the past protected low, forming a higher low, which was then followed with a higher high on the internal price action, therefore a break of structure internally. Now, after a break of structure, similarly like the one from before, we expect a pullback. And the pullback should close above the past protected high, meaning that this low should not break, being a protected low. Knowing the theory, we can look for buy positions near the low by identifying a support or demand zone. Now this trade closes on the take profit and continues to push very aggressively to the upside, so the pullback actually happened here, a pretty small pullback before entering into another upside continuation, from where the market is starting to pull back down. And we can actually trade this once again from the recently formed support. And to increase the quality of the setup, we zoom into a lower time frame. This is on the 15 minutes chart, and here we can clearly see the downtrend fundamentals of lower highs, with lower lows. But this happening on the internal price action, if the market would have any bullish reaction from a level, it should be near the support or demand level. So we can place the buy setup, with the stop loss below the previous protected low, because keep in mind that higher lows on uptrends are protected lows. And for the take profit, we will look to target above a previous internal high, but for that, we need to wait for the market to form those levels in the first place. Now here it's when these highs have been formed. Notice the internal highs that are followed right after with internal lows that break down the past low, this happening multiple times. So the take profit logically should be placed above one previous high. Now this is the case, because this time we are trading a low time frame reversal from a downtrend into an uptrend to basically align the trend in a way that we follow the higher time frame trend, which is bullish. We can exit here, but the risk reward is kind of not worth it. Here, or above right here, and this one is great. Now we need patience. The position fills pretty quick, with a nice bullish reaction. Reaction that a couple candles later push into the take profit, and even higher. Don't get surprised if your win rate and risk-reward ratio both increase after this video. Also, my members of my program, which you can find on the description of this video, not only start being profitable, but most importantly, they keep profitability in the long run.